everyone. Welcome back to my channel. My name is Kaley Gray. I'm doing weekly vlogs about life, faith, and relationships. So be sure to subscribe and follow me on my social media. I'm super excited today to have my cousin Kyle Gray Parmenter on the vlog. He is I have to read this. He is a mortgage banker loan officer. That's a mouthful, but I am so excited because the beginning of this year, we did a vlog about kind of getting your finances right in 2022. And I wanted to ask Kyle because he helps a lot of people with purchasing homes and things like that. And so I wanted to ask him because I feel like, Kyle, a lot of singles now are like going into relationships already owning a home. I know you just built a home, which is amazing. And so I don't know if you're single, so sorry. Didn't mean to put you on blast.
Definitely not married, so, but yeah.
Yeah. And so anyways, so a lot of people are, stepping into that season because it used to be like you were married. That's when you would like buy your first home together. But a lot of people are stepping into those relationships already. And I'm like, as a single, I have no idea like what to do, like to even purchase a home, like what steps I even need to take. And most don't. And so that's why we're doing this vlog, and you are gonna like bring some light to all of these questions I have. So thank you for allowing me to just pick your brain.
Thanks for having me on.
Yeah. Okay. So what does a mortgage banker loan officer do?
So, we have a lot of kind of different hats. Some call us advisors, some call us loan officers, some call us mortgage bankers. So yeah, kind of a mouthful like you said there, but like I said, wear a lot of different hats, but at the end of the day, my main goal is to get clients into a house so they can begin building equity, basically. So we want to find the best loan product and the best structure for that loan to make sure it makes sense for their situation. We have a lot of different calls and run a lot of different numbers, stuff like that, but basically making sure that we're getting them into the best situation possible while also building equity. So that's my main goal. Now, qualities for being in this field, you have to be very organized, have some financial acumen, definitely. And then just trust and communication is a big part of it too. These are very big transactions we're making, and in the realtor senses, it's a lot of trust being put on us too, that the deal closes because it's their commission at stake too. So those are the three, I'd say, main qualities that it takes to be good at this job. But yeah, all in all, we're very client-based and just want to make sure that you guys get into the best house for yourself. It's important, I think, to understand the reasoning behind these decisions. Sometimes you might be buying down points on the rate if you're going to be in that house for a long time, or if you're going to be only in there a few years, or you're an investor, then it might make more sense to take a lender credit towards closing and actually take a higher rate. So we kind of talk through those types of things and find basically the perfect situation for each person. So we have like kind of models we use to make sure that we're helping them and making sure that they're getting their money back in the right amount of time to do make that decision. And my kind of big thing is like, cash is king. So you're going to make a lot more money in the market, aggregately, than you will be paying interest right now with the rates so low. So I always recommend really trying to keep as much cash as you can on the sidelines for that. But you're getting like 10% say in the market and you're only paying like 3.5% interest. It makes a lot more sense to have that cash on hand, whether it's reserves or a bunch of different things or investing. So that's kind of our job, is to go through all that with you guys and make sure that you're educated before you make, probably for a lot of people, the biggest investment they've ever made in their life. So try and become a trustworthy person for them.
That's awesome. Well, I definitely feel like you're trustworthy. So I think this is a great profession for you. And too, with you saying that, I didn't realize there's not like a one hat fits all, sort of thing. Like you do a model based on the person's needs. And so that's neat that you guys have that. Okay.
Well, probably not all lenders are going to be as ready to offer that up that's why it's good to find a very helpful lender as well. I will kind of say that on the side. It kind of depends on which lender you have, how much they're actually going to run those numbers for you and be willing to help as an advisor aspect of it. So.
Okay. That's great information to know too. Okay. So pros and cons of owning a home versus renting.
Okay. So the biggest pro is it's historically proven, is the best way to build wealth is through real estate. Whether that's a primary residence, some people invest in real estate, do flips, or do investment properties where they rent it out a bunch of different ways, but it is the best way to build wealth, and that's proven years over years over years. So building that equity is key for anyone in the long run. There are some cons that include maintenance, taxes, insurance, but all in all, I mean, that's nothing compared to the equity you're building. So it's kind of a myth that you're going to lose money buying compared to renting. I've heard people say that to me, like, isn't that true? You're going to actually lose money? No, you're probably going to lose some time, but you're definitely not going to lose money. So if you're, have a little bit of willing to put a little bit of sweat equity into it or whatever else, I mean, you're going to make money. There's just no way not to, unless things would have to go very, very wrong for you.
Okay.
So that's kind of the negatives, but they're very much outweighed by the positives for sure.
Yeah.
Really the key is just to kind of get that first house purchase, let the wealth build up, and then by the time you do your second home, you already have equity built, which can kind of roll right into your next down payment. So it's just a cycle, basically. Basically you want to get out of the renting as quickly as you possibly can is my best advice to anyone, especially with rates this low. And that's why demand is high. That's why a lot of people are a little bit, scared to buy a home in this market. And I don't particularly blame them, but it's one of those things that with demand this high, that's just how it's going to go. With demand and rates are going to always correlate in that regard. There's also another pro, I guess there's some tax benefits too. It's not going to, I guess, you're still going to end up paying, it's going to be a negative tax wise, but there are benefits that aren't talked about enough in regard to mitigating those taxes that you do have to pay. But all in all, at the end of the day, it's a big time win. So I actually brought a little graphic I can share with you guys here, a couple graphics.
Yeah.
The first one I was going to show just kind of shows, just let me know once you can see it, Kaley.
Okay.
Oh, whoops, there we go.
Okay.
Cool. So this first graphic here, this just kind of shows you 9 years of renting compared to 9 years of buying. So there's a cash flow difference. Obviously, just because it's cheaper to buy than rent in a lot of instances while you're building the equity. And then there's the appreciation of the house itself. So in this model, it's basically you're projected to make your value is supposed to go up from $3,500 to $499,000, and that's huge just off appreciation, obviously. And then amortization is basically the equity you're building in regard to month by month. Once you pay your interest down, then you're just building equity off the principal. So those are two big factors. And you'll see up here too, maintenance and repairs and property taxes and everything per month are also already factored into this as well. So that's where that myth kind of comes in. But all in all, when you include your original closing costs, cost to sell, which is like realtor fees, put those in with these benefits, in 9 years, you're looking at $210,000 gain on buying a home, a $350,000 home, basically. So that's only in 9 years, and that's pretty incredible. And people have actually probably done a lot better than that recently with home prices increasing. And hopefully a lot of them are refinanced as well. That's something I'll mention is if you haven't refinanced in the past couple of years, you definitely need to, because rates are going up pretty quickly here. So I would probably get that done if you have not. And then second one here. So this is just kind of shows you what interest rates are expected to do. So say you can get a 3% interest basically today, just off the projections for next year, we're supposed to be up at 3.7, if not higher. We've actually been the past couple months, this flyer was made a couple months ago, we're actually trending a lot higher than that, I would say, unfortunately. But home prices are also doing the same thing. So you're building equity and you get the lower rate instead of having to pay the higher rate. So in this instance here, your monthly payment, and this is an expensive house, so maybe not applicable to everyone, but you're, basically $500 a month. Your payment could go up next year for trying to what we call time the market or anything like that, which I'd never recommend in any market personally, whether it's equity markets or real estate. But yeah, and then kind of what it costs here. So like $500 a month, that could be groceries for a family, $6,000 a year, that's a family vacation. Then over 30 years, it costs you 180 grand. So, I mean, it's a big deal. So that's why I always try and get as many people as I can into houses and, help them set up the best situation for themselves. But I just want to kind of show those two visuals for you.
Oh, that's so great. I love that. That really puts things into perspective. Okay. So I know people have big dreams, like, that house the things you were just saying, I mean, it sounds amazing, but we need to be realistic on what we can afford. So how much does one person, how do you figure that out? Like how much you could afford for purchasing a home?
Yeah, so there's a lot of different factors. The most important in our field, I guess, is the debt to income ratio. So that's going to basically it's going to be a percentage of your total debts compared to your gross income per month. There's different people who have different recommendations. Like Dave Ramsey doesn't want you to go over 28% DTI. I personally am, I think 32% is fine. My boss might think this or that. So everyone has their own kind of view on it, and it's really personal preference. But in theory, we can take you up to about 50% on a conventional mortgage, which is pretty high. You also want to be careful not to become house poor, because that's a thing that some people do, and then maybe a traumatic life experience happens or something. So I personally, with my clients, try and suggest a little bit of wiggle room, but we can take them higher, especially if they're expecting to have a big increase in pay in the coming year or something. There's situations where it makes sense to go higher ETI, but all in all, I personally recommend 32, but we can take up to 50% or so, and even higher on FHA. So just kind of an example, say you make 50,000 a year, that means about 4,200 a month gross. So if you want to keep that under the 50% DTI, so that includes your full mortgage, including interest, taxes, all of that. So we call it PD, principal, interest, taxes, insurance. So that full PD is included in the mortgage payment, and then plus your car payment, student loans, credit card debt, maybe things like that, all factor into the debt aspect of that ratio. So that would all need to stay under like $2,080 or so in order to fit that 50% bill. Now, if it was my client, I'd probably urge them to go maybe a little bit lower like I said, but it's really up to each individual person and what their next few years might look like. And that's part of why it's so important to have, another good reason why it's so important to have a good loan advisor, and not just a loan officer or a banker or something, just someone who's willing to work with you and make sure you're making that right decision. But so it's really different for each person, and there's a lot of different angles, but all in all, that it comes down to mainly that debt to income ratio, and then like your reserves and stuff like that. So,
man, so good. Okay, are you ready for more questions?
I am. Yep.
Okay. So what is the first step I would need to take if I was like wanting to purchase a home? Because I feel like, like when you go get your driver's license, they're like, oh, you need this and this and this. I feel like there's something that you need from us to be able to do this before just like seeing a home and be like, I want this home.
Yeah, and I think most realtors will agree with me on this, that most want you to be pre-approved before they start touring houses with you. Because you could have someone who is not going to qualify going around looking at $800,000 houses and wasting realtors' time or whatever. So usually the first step that most recommend is getting a pre-approval letter. So what that entails is usually a full application, and then you need like last 2 years W-2, most recent 2 paychecks, last 2 months bank statements, driver's license, all that good stuff. We basically put it through an underwriting system and see and we also get, with all those docs, and make sure that basically you can afford whatever amount you're wanting to. I mean, some just want us to run it up to what's the max I can afford. Others are like, I don't want to go over this number, so please just give me a pre-approval up to this amount. And this market has gotten a little tougher to do that because, people are going so high over lists, at least in Kansas City. But it's usually when I'm working with my friends or really anyone, I'm like, okay, you want to go 350? Well, we might go 375 to be sure, so you can get some escalation offers in there, just in case you find one you love and I don't have to get you a rush pre-approval or like an emergency one if I'm not able to, just to have a little extra wiggle room. But yeah, so that's usually your first step, get that pre-approval. And a lot of times if you go straight to a lender first, then you're gonna need a realtor. So I have a big, base of realtors that I can refer out to, but a lot already come to me with one. So it really just depends, but basically that's your first 2 things. And realtor wise, you obviously want to make sure you're getting someone you trust. There's, I like to think most people are trustworthy, but there are some horror stories I've heard about people who just went with like random realtors and, it didn't work out too well for them. So with clients I work with, I usually like to at least drop a few names that I really trust and say, look, at least give these guys a meeting and see what you think and that type of stuff. I think that's a very big part of it. But yeah, and then after that, it's just basically the communication between the borrower, realtor, and lender are so important throughout the whole process, because deals can fall through, closings can get pushed back. That can be especially bad if there's someone moving out of state or needing to move for, like right now, for a whole different assortment of reasons. So that's going to be, I guess, your next step in the process, just making sure all 3 of those people are tied in very tightly and in the loop on everything. But that's another very important step. And then one thing I always really like to make sure people are aware of is while you're in the process of buying a home and you've already been pre-approved, or in some instances you're under contract, do not take out any more debt. I don't care if it's a Shields credit card. I don't care if it's a new car. I don't care what it could possibly be. Once you're in that stage, anything could mess a deal up, because we have to run our credit again before we close the deal. And that has killed deals before, because all of a sudden we're like, you just went and bought a car that you're paying like $350 a month on. Like now your DTI is too high and we can't get this done. So like, that's the biggest thing that a lot of people don't understand, is how important that is while you're in the process of buying a home, to get that done. And then if you want to get that car, you want to get a Shields credit card for points or whatever, get that after you close. So that's one big thing. So I guess that's not just the first step, but I just wanted to kind of walk you through some of the important steps of the process as well. So
no, that's so good. Okay, so I know we kind of talked like realistically about like how much we can afford and things like that. Usually you have to put down a down payment. Is there like an average down payment that somebody must put down?
So that's another one that kind of varies by person, I'll say, in situation, because at the end of the day, we want you building equity instead of renting. So in theory, you can honestly pretty much buy a house with $0 down with like lenders credits or other down payment assistance. There's first time home buyer program. There's a lot of different ways that we can get you into a home, basically, without a down payment. And then once you build some equity up, maybe you can refinance out. You might get a higher rate, or you might get a little bit less desirable loan product than you would with someone who is going to be putting at least 5% down or something. But at the end of the day, we can get anyone into a house pretty much, as long as the credit score is there, the DTI is there, and there's at least a tiny bit of reserves. But it's not, it's not a one size fits all. But I'd say for conventional, there's like a conventional 97 program that allows just 3% down flat. A lot of people use that, I'd say. Once again, they want to hold their cash. Maybe sometimes they even have more to put down than 3%, but they just want to put that 3% down so they can, hold that cash and put it to work other places. But I'd say, my personal opinion, I think you should probably try and have about 5% of the purchase price to put down. Once again, that can vary for each situation. If you're having a hard time getting there, down payment assistance is an outstanding option, because once you start building that equity, it becomes almost like addicting. Like you just want to keep finding ways to better yourself. So sometimes all you need is just that kick, just to get into a house. So you can get into it basically any type of way. The only way to avoid PMI is to put 20% down. There's not that many people that do that these days, at least around our age, first time home buyer types. Now, once you have equity built in your first home or second home or whatever, if you want, you could probably put 40% down and have no issues. But you want to make sure that you're using that equity you have built wisely. But first time wise, very few have the 20% to put down to avoid PMI. So you will be paying that, which is called private mortgage insurance. I'm not sure
I was like, I don't know.
Sorry, I should have mentioned that. Sorry, but yeah. So basically, it's just insurance premium that you have to pay for the bank or whatever taking a little bit more risk is what it is. So it's maybe, depending on the situation, like $80 to $180 a month. So if you go back to that model, though, it's still going to be a lot more beneficial to be building equity even with that than it would be to be renting. But the only way to avoid that PMI is to have 20% down. But very rare these days, I would say.
Okay. Wow. This is so great. Okay. So you kind of talked a little bit about credit, and this kind of goes into my next one. Like, do you guys have like tricks or trips if somebody doesn't have the best credit and they do want to start buying a home soon? Like, is there ways that they can improve their credit?
Yeah, definitely. That's something that we actually have kind of credit repair doctors that we can use.
Okay.
So we can actually send our borrowers there and say, can you please help them get here in 6 months or a year? They have this much time. Just give them some income details and debt details, kind of figure out, okay, what can we do here? And there's also just kind of some common sense ways you can do it yourself too. If you don't check your credit score regularly, I would recommend at least checking it once a year. Everyone can do that for free. You also, if you have like a card, like a Discover card or anything, like I see my FICO whenever I want. That's not 100% online with the credit bureaus, but it's a pretty good indicator of where you're at, I'd say. But there's really a lot of easy ways. So like payment history is going to be the biggest factor. Like if you're missing payments on any sort of debt, whether it's car, student loan, anything like that, that's going to hurt your credit score pretty bad. That's 35% of the weighting of a credit score right there.
Okay.
So that's almost getting close to half. Then credit utilization is the next biggest one. And they always want you to aim for 30% or less. So that's actually one area that before buying my home that I raised mine doing that I wasn't quite aware of at the time, because I wasn't doing this yet. But basically, so like, say you have a $5,000 credit limit, but you're using like $3,000 of it every month. then that utilization is going to hurt your credit score, even if you're paying the full balance off. So what you would want to do is maybe up your credit, even though you don't plan to use it, or at least hopefully up your credit limit to maybe 8,000, 10,000. Then you're under the utilization levels where they're more comfortable with. That's going to help you definitely build your score pretty quickly. Those two are going to be the biggest factors. And then you also have your age of kind of just credit counts, which is kind of like also just your history in general. And some people, which in theory is good for them, they just have never used debt. So unfortunately, that's not going to help your credit score though. It's going to hurt your credit score. Or if you pay a car off too early, for example, then that's going to hurt your credit score, which doesn't make sense to me either, to be honest with you.
Yeah.
But I think it's still worth it probably to go ahead and pay that car off early, but that's just a side note. But all in all, just having credit history is going to help a lot. That's about 15% of the weighting. And then credit mix is 10%. So they kind of want you to have a few different types of credit. So like student loans, maybe might be one, a car, and then a mortgage. Like those three alone would probably be pretty powerful little three. Obviously you don't want to be going way too crazy with the credit and having like 12 different credit cards and like a bunch of, keep it within reason. And once again, these are lower weightings, but that's just ways you can maybe help a little bit, even if you're putting like 500 a month on it and just paying it off. The new credit inquiries is another factor. So anytime we run someone's credit, it costs them a few points. Like we say on average, like every time I run a credit, it's like probably 3 points. So that's not that much, obviously. It's not going to make or break your rate or anything like that, but it is worth mentioning that if you're having a bunch of people pull it, or you're, you want to try and limit how many times it's pulled, basically, if within reason, I'd say. So that's just another factor that I wanted to mention. But all in all, those are all the key things. And I think a lot of it can be done, on your own, honestly. But if it does if it's a dire enough situation where you need a credit repair doctor, the lender can usually set you up with one, or you can go online and find one. But all in all, there's some pretty just no-brainer ways to do it on your own, just yourself. So, but I guess for what you're looking at for a house, I mean, there's some loan programs, especially FHA, you can go down to like 580 credit score, some even lower, to get that FHA loan. But in order to do conventional, you have to be higher than that. We personally look for about 640 or higher to run a conventional, or else the pricing just gets too bad. We'll have to do FHA. But anything over 740 is considered basically perfect in our world. So you can have 741, you can have 810. That's going to be considered the same bucket. But from there, it's just little kind of 20-point increments that have little incremental effects on the rate. But yeah, so that's kind of how the credit aspect works.
Man, I feel like I've learned so much today from you. Thank you, Kyle. Like, I appreciate this. Is there anything else like you want to share? I feel like you shared it all, but I don't know if you have any.
No, I mean, I guess if anything, I'm always available for questions, calls, texts. I mean, emails. So I'm always happy to help, even if you're not looking for a house that exact second. I'm happy to help and maybe see how I can get you in one down the road or something. So never hesitate to reach out to me with any questions or anything like that. I'm always happy to help.
Yay, that's perfect. So I'm going to put all of his information below so that you guys can get in contact with him, because you can pretty much help anyone out anywhere, correct?
Yeah, pretty much. Yep.
Because I forgot to mention, he is in Kansas. I'm in Oklahoma. Our parents, his mom and my dad, our brother and sister, and they grew up in Iowa. So we're Iowa Hawkeye fans. So
you are. Go Hawks.
Yes, I love it. Well, good. Well, thank you so much, Kyle, for just taking the time and just to inform, because I think this was so informative. I learned a lot today. I need to kind of reevaluate my life because I'm renting, so don't judge me right now.
Oh, no. Yeah, I mean, it's one of those things. It's a lot of people are for a bunch of different reasons, but it's one of those things that I couldn't recommend it more, to start building that equity up whenever you can. So
no, that's awesome. Well, thank you so much. I hope that you guys enjoyed today's vlog, and I will see you all next week. Bye.
See you guys.